This is OwlUp, where learning happens in minutes, not hours. For a deeper journey, explore all our courses at owlup.co. Now, let's dive in. Welcome back to Chapter 4 of our series, How Investing Really Works, The Complete Picture. In this episode, titled Funds, Pooling Resources with Others, we're going to explore the fascinating world of investment funds, like mutual funds and ETFs, and uncover how they can help you invest alongside others. So, let's dive in. Roughly half of U.S. households already invest together without realizing it. Your retirement plan at work, a basic index fund in your app, even some robo-advisors, all of them quietly pool your money with strangers. The twist is how that shared pot changes your real risk. Roughly 100 million Americans already use funds, yet most couldn't tell you who actually decides what's inside them, or what they're truly paying for. That blind spot matters more than any hot stock tip. When you hand your savings to a fund, you're not just pooling money, you're outsourcing thousands of tiny decisions. What to buy, when to sell, how concentrated to be, how much risk to take in the background while you're busy living your life. Some funds follow strict rules, like a recipe that must be cooked the same way every time. Others give a chef wide freedom to improvise. Some funds are cheap, some quietly expensive. Over time, those differences compound into real dollars you either keep or give up. To use funds well, you don't need Wall Street jargon. You need to know which levers actually change your outcome. Some of the most popular funds don't even try to beat the market anymore. They're built simply to be the market. Think of the S&P 500 or total market funds that quietly mirror thousands of businesses at once. Others still rely on managers making active calls. Overweight this industry, avoid that country, hold extra cash. On the surface, they can look similar in an app. Same broad label, similar chart. But under the hood, the rules, turnover, and tax consequences can be radically different, especially once you place them in a taxable account versus a retirement account. Most people first meet funds through a retirement plan menu or a balanced option in an app, not through a ticker like SPY or VTI. Behind those plain labels are a few design choices that quietly shape almost everything that happens to your money. What the fund can own, how concentrated it's allowed to be, how often it's allowed to trade, and how much it's allowed to charge. Start with the simplest: scope. A broad U.S. equity fund might hold thousands of companies. A sector fund might hold only chip makers or biotech. A theme fund might narrow further to, say, clean energy or cybersecurity. Narrow scope means your outcome leans heavily on a single story working out. Broad scope lets a lot of different stories play out at once, some winning while others lag. Then there's the rulebook. Even funds tracking similar indexes can behave differently. One may follow a total market list that keeps tiny positions in small, illiquid companies. Another tracks only the largest, most heavily traded names. That affects how closely the fund can match its target and how much it spends behind the scenes to stay on track. Costs aren't just the headline expense ratio either. Trading frequently to chase short-term moves can create spreads and taxes that investors never see itemized. A low-stated fee paired with high turnover can, in practice, feel a lot like a higher fee fund that trades less. Transparency also varies. Some ETFs publish holdings every day. Many mutual funds report only quarterly with a delay. If you're trying to avoid over-concentrating in a single stock or industry across all your accounts, being able to see what you actually own inside each fund matters. One helpful mental model comes from medicine. Some funds are like broad-spectrum treatments, covering many risks moderately well, while others are precision drugs, aimed at one narrow problem. Neither is better in isolation. They're tools. What matters is how you combine them with what you already hold, your time horizon, and how much volatility you're willing to ride out without bailing at the worst moment. And looming above it all is scale. As funds grow into the hundreds of billions, it can become harder to take meaningful positions in smaller companies without moving prices. That can subtly push a fund's behavior toward the biggest, most liquid names over time, even when the label on your statement doesn't change. A single ticker can hide wildly different experiences. Take two funds, both labeled US stock. One might tilt heavily toward fast-growing tech names, another toward steady dividend payers. Same shelf in your app, very different ride when markets lurch. Or consider bond funds. One can hold mostly short-term government bonds that barely wiggle, another can load up on long-term corporate debt that sinks when interest rates jump. Both just show up as bond in a 60-40 pie chart. Scale shows up in odd places too. A giant ETF tracking smaller companies might quietly own such a big slice of certain names that getting in or out nudges prices. That doesn't break the strategy, but it can slightly widen the gap between the index on paper and the result in your account. Your challenge this week? Pick one fund you own, look up its top 10 holdings and average turnover, and ask, is this really giving me the mix of companies and trading activity I thought I signed up for? Funds are quietly turning from static baskets into adaptive systems. As costs drop and technology improves, more strategies can react to new data, climate risks, supply chain shifts, even real-time credit signals. Think of weather forecasts getting sharper and more localized. Fund menus could evolve the same way, letting you dial in exposures to specific risks or themes while still riding in a broadly diversified vehicle, instead of stitching together dozens of fragile, niche bets on your own. Over time, whole ecosystems can form around your choices. Target date funds that quietly age with you, ETFs that tilt toward climate data, even portfolios that sync with cash in your checking account like a thermostat. Your role shifts from picking stars to setting dials, deciding what trade-offs you accept, then letting the machinery hum in the background. Before next week, ask yourself, where in my life am I already informally pooling money, like group gifts, shared subscriptions, or travel plans? And what would it look like to turn just one of those into a more intentional fund with clear rules and a shared goal? Who are 1 to 3 people I trust enough, both financially and emotionally, to consider starting a small, low-stakes fund with, for example, a yearly trip fund, mutual aid circle, or family emergency fund? And what specific boundaries or agreements would I need in place to feel safe? If a fund you joined suddenly faced a hard decision, like who gets help first or what counts as an acceptable use of the money, how would you want that decision to be made? And what process could you suggest now so future you doesn't have to navigate confusion or conflict later? This was OwlUp, your daily step forward. This series continues with more chapters on OwlUp.co. Visit OwlUp.co to access the complete course and continue your learning journey. See you there!